Welcome to the Coin Bureau Weekly Crypto Review. Here are this week's top headlines in the crypto news. Cut out by corporations. Sanctions continue to sever Russia from global commerce, and now even Visa and MasterCard are pulling out. Will this lead to the adoption of cryptocurrency? Exchange exceptions. The CEOs of Binance, Kraken, and Coinbase refuse to ban Russian citizens from their platforms, but warn they could be forced to. Here's why. What's in your Web3 wallet? MetaMask and OpenSea block users from certain countries, revealing the centralization of some of the most popular infrastructure in cryptocurrency. What you need to know. Starlink and censorship. As governments around the world clamp down on information in the name of misinformation, Tesla CEO Elon Musk fights for free speech. How is crypto helping? Bitconnect founder disconnects. The man behind one of crypto's largest Ponzi schemes mysteriously disappears. Where could he have gone? USDT ubiquity. After achieving adoption in Myanmar, crypto's largest stablecoin sets its sights on Switzerland with a historic partnership. Is USDT why Venezuela is forcing its own cryptocurrency? Inflation in every nation. The cost of energy and food continues to soar around the world as investors anxiously await official inflation figures for February. Why this is the last thing to be concerned about. And a closer look at what comes next in this week's crypto market forecast. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy, and what you're about to see is educational content, not financial advice. You can find any topics you're looking for using the timestamps in the video timeline. And now for today's top stories. Last week, we saw the continuation of unprecedented sanctions against Russia in response to its invasion of Ukraine. This time around, the sanctions came mostly from the private sector, with some of the biggest brands in the world pulling out of the country. Over 130 corporations and counting have participated in the sanctions, including video game companies like Activision, tech giants like Apple, and even furniture company IKEA. Over the weekend, 2 additional brands were added to this list, and they were arguably the most significant to date. Visa and MasterCard will both be restricting their operations in Russia. To put things into perspective, Visa and MasterCard accounted for around 75% of all the credit cards issued in the country in 2020. This begs the question of how regular Russian citizens will be able to make the transactions they need to survive. But there seems to be more to this headline than meets the eye. While the press release from MasterCard implies that the company will be pulling out of Russia completely, the press release from Visa suggests that any cards issued there will still work in the country, but not anywhere else. Similar sleights of hand have been seen with companies such as Shell, which have continued to purchase Russian oil at a discount and sell it at a massive profit on the grounds that it does not violate sanctions decreed by the US government. Large asset managers such as BlackRock and Vanguard have also reportedly been investing aggressively in Russian stocks at a massive discount and could stand to gain the sort of percentages you usually only see in crypto. Meanwhile, retail investors have been sidelined from doing the same by platforms like eToro and exchanges like the London Stock Exchange, which have halted trading and delisted Russian stocks. Anyways, these are just a few of many recent events that have underscored just how centralized and corrupt the current financial system is, and they may be a part of why the number of Bitcoin wallets holding BTC recently hit an all-time high. Another possible reason why Bitcoin wallet balances are increasing is because people are starting to realize that they're not safe from centralized financial controls unless they custody their own crypto. This fact was put on full display a few weeks ago when the Canadian government asked cryptocurrency exchanges to freeze crypto coming from wallets belonging to protesters on their platforms. Back then, cryptocurrency exchanges responded by saying that they would have no choice but to comply, and Kraken CEO Jesse Powell went as far as to recommend staying away from centralized exchanges such as his. Today, cryptocurrency exchanges find themselves in a similar situation regarding Russia, with calls from select Ukrainian officials, as well as some US politicians, for them to restrict access to Russian users. The difference this time around is that there are technically no official sanctions against regular Russians by Western governments, only a handful of Russian oligarchs who are believed to be personally responsible for the current crisis. The CEOs of Binance, Kraken, and Coinbase have all come out to say that they are abiding by these sanctions in accordance with the laws of their respective lands, but refuse to extend them to regular Russians, especially since many of them are currently using crypto as a lifeline. Ironically enough, even the Russian central bank is calling for crypto to be banned within the country, as citizens dump the ruble in favor of stablecoins such as USDT. Even so, this hasn't stopped the critics from claiming that centralized cryptocurrency exchanges should be doing more to pressure Russia's population into protesting against the actions of their politicians. Proponents, on the other hand, have argued that doing unnecessary damage to individuals who are not personally responsible for the conflict will lead to radicalization rather than revolution, and that access to financial services is a basic human right. Jesse Powell came in once again to set the record straight, effectively stating that it's not a matter of opinion, but of legislation. If crypto exchanges are required by law to ban Russian users, then they will have to do so, regardless of what anyone thinks. Jesse also hinted that such a law could be in the works, but I have a feeling it's unlikely to materialize. This is down to what I mentioned earlier. Many Russians are dumping the ruble in favor of stablecoins which are denominated in US dollars. This ultimately benefits the dollar's status and strength. This is just the tip of the iceberg too, because most stablecoins are backed by government debt, and you can learn more about that using the link in the description. Anyhow, just when you thought crypto couldn't get any more tense, word has gotten out that some Web3 service providers are not nearly as decentralized as they seem. For starters, there's OpenSea, the largest NFT marketplace in cryptocurrency, which confirmed that it's blocking users with Iranian IP addresses from interacting with its platform. As you might have guessed, this is because OpenSea is based in the United States, and the United States has had sanctions against Iran for many years. In an email to Decrypt, an OpenSea spokesperson specified that the terms and conditions of the platform specify that it will restrict any users found to be operating from within sanctioned countries. What's odd is that Iranian users were apparently able to access the platform without any issues until very recently, despite US sanctions and OpenSea's terms and conditions. This timing seems to coincide with moves made by MetaMask, the largest browser extension wallet in cryptocurrency, to block users from Venezuela, though the headlines were a tad misleading here. That's because it wasn't MetaMask that blocked Venezuelan users per se, but Infura, an infrastructure provider for developers and decentralized applications on Ethereum, including the MetaMask wallet. Infura mentioned on Twitter that Venezuelan users of MetaMask were accidentally banned as a result of newly deployed geo-blocking technologies, which were used, quote, more broadly than they needed to be. In an email to CoinDesk, an Infura spokesperson explained that it too must abide by US sanctions laws, and that the jurisdictions that are currently off-limits are, quote, Iran, North Korea, Cuba, Syria, and the Crimea, Donetsk, and Luhansk regions of Ukraine. Many people on Twitter responded by saying that this calls into question the decentralization of some of the most popular tools and services in cryptocurrency, with some going as far as to say that MetaMask is no longer a permissionless wallet. The good news is that the centralization of services such as Infura is an issue that's been known in the crypto community for quite some time, and many projects, such as Polkadot, are rushing to develop decentralized alternatives that can't be censored by often arbitrary foreign policies. More about Polkadot in the description. I digress. Now, as far as I can tell, the sudden moves by OpenSea and Infura were a response to the concerns that US politicians are raising about Russian oligarchs using cryptocurrency to bypass sanctions. Besides the fact that this would be very difficult to do, given the limited liquidity in cryptocurrency, as well as the traceability of transactions on the largest cryptocurrency blockchains, I will again reiterate that a crypto crackdown is unlikely to happen on these grounds due to stablecoin dollarization. What is much more likely to happen is a crackdown on so-called misinformation and disinformation by some governments around the world which have taken to heart the phrase, "never let a good crisis go to waste." In the European Union, Russian media outlets have been banned. In Russia, Western media outlets have been banned. In North America, politicians are pushing to ban not only Russian media outlets, but information that goes contrary to established narratives about specific subjects. Here in the United Kingdom, politicians are trying to push the aptly titled Online Safety Bill, which has raised flags at various independent human rights committees due to its vague wording. Now, this pales in comparison with the Identify and Disrupt Bill passed in Australia last summer, which allows authorities to hack the computers, phones, and social media profiles of anyone they suspect of having committed a crime. As many crypto news outlets have pointed out, it is absolutely imperative to have free access to information, including information from media outlets that some would consider to be state-sponsored propaganda. That's because without free and open discussion, it's impossible to find the truth. And this is something Tesla CEO Elon Musk shouted from the rooftops, or rather, posted on Twitter. Specifically, Elon said that, quote, "Starlink has been told by some governments, not Ukraine, to block Russian news sources. We will not do so unless at gunpoint. Sorry to be a free speech absolutist." For context, Starlink is an internet service started by Elon Musk's second company, SpaceX, which consists of satellites that beam internet signals directly from space. Obviously, this doesn't require any cables or wires, and that's made Starlink's internet service a godsend in remote regions and those with spotty internet infrastructure, such as Ukraine, which recently received a massive shipment of Starlink satellites, courtesy of the Doge father himself. A crypto project called Helium does something similar here on Earth by making it possible to transmit low-frequency radio and 5G peer-to-peer. More about Helium in the description. Now, on the censorship side, you have crypto projects like Arweave, which make it possible to store data indefinitely in a decentralized manner, and many people have been using Arweave to store headlines about Russia and Ukraine from both sides using Arweave's intuitive browser extension wallet. Full disclosure, I hold AR, and you can learn more about Arweave in the description. Now, when Elon Musk isn't busy blowing up the internet with his antics, it seems he's busy blowing up the inbox at the Securities and Exchange Commission, which recently decided to respond in kind. Luckily for Elon and other crypto projects caught up in the SEC's web, it has a bigger fish to fry, and that's the founder of the infamous Bitconnect Ponzi from 2016. For those unfamiliar, Bitconnect basically promised to give insane returns on any BTC lent to the company, and these insane returns naturally came from a nebulous trading bot which didn't actually exist. In reality, the new cash coming in was used to pay the people cashing out, a classic Ponzi scheme. When it all came crashing down in January 2018, investors were left with over $2.4 billion in losses, and the alleged orchestrators of the scheme have probably had a price on their heads ever since. Now, the supposed founder of Bitconnect is an Indian man by the name Satish Kumbhani, and this is who the SEC is after. The SEC initially sued Satish in September last year, and they were in talks with Indian officials to figure out where he was so they could hand him the papers. Satish was officially charged by the SEC last week, but there's just one small problem. Satish seems to have disappeared completely, and it's believed he left India as early as last October. In terms of where he went, well, my best guess is somewhere in Latin America or Asia, where it's possible to live in luxury under the radar, or so I've heard. The reality is that nobody knows for sure, and I haven't really got a clue either. Now, forgive me for my suspicion, but I find it very strange that international authorities are unable to track down a single person, given that almost everything you do these days is tracked in some way, shape, or form. And authorities probably have easy access to some, if not all, that information. This situation is eerily similar to what happened in the wake of the South African AfriCrypt scandal, which saw the founders of the investment scheme disappear with a staggering $3.6 billion in BTC. Nobody has been able to find them either, but Something tells me it's only a matter of time, given that authorities were able to track down the BTC from the Bitfinex hack. More about that saga in the description. Speaking of Bitfinex, some of you will know that its sister company is Tether, the issuer of cryptocurrency's largest stablecoin, which is, of course, USDT. Despite regulatory uncertainty, USDT has seen significant adoption over the last few months, the most memorable of which was its use as a currency by Myanmar's government in exile. In Ukraine, the Ukrainian government has also been using USDT donations to fund its operations, and Ukrainians as well as Russians are using it as an alternative currency, as I mentioned earlier. What these three countries have in common is that they are facing a significant amount of internal strife and uncertainty, which is why the news that a Swiss city would be adopting USDT took many by surprise, since Switzerland is about as stable a country as they come. The unprecedented announcement by the city of Lugano will see it partner with Tether to pilot USDT payments on, wait for it, Bitcoin's Lightning Network. If that wasn't crazy enough, the city is reportedly looking to allow its citizens to pay tax using cryptocurrency in the near future. This would actually make it one of many cities and regions in the country that accept cryptocurrency for taxes, but it would make it the first to accept USDT for this purpose. Whether the Swiss government allows Lugano to do this is another question entirely, and history suggests that it might not take too kindly to the adoption of a de facto digital dollar. This is certainly the case in Venezuela, which has likewise seen a substantial amount of crypto adoption, including USDT. It seems that the Venezuelan government has realized that cracking down on a decentralized peer-to-peer technology is pointless, as it has opted to create a cryptocurrency of its own. According to CoinDesk, the Petro token is built on top of the Dash blockchain and will be used to pay the country's new minimum wage. As you can imagine, most Venezuelans are only using the Petro out of necessity for certain payments such as taxes or pensions, and otherwise try and steer clear of it as much as they can. In contrast to actual cryptocurrencies, the Venezuelan Petro is completely controlled by the Venezuelan central bank, and its official block explorer hasn't shown any information since April of 2020. The Venezuelan Petro can therefore be seen as a sort of synthetic central bank digital currency described by the World Economic Forum's Stablecoin and CBDC report, which you can find in the description. Now, if you're wondering why Venezuelans are adopting crypto, the answer is inflation. And at the rate that other currencies are inflating, it looks like many other countries could soon be in the same boat. The inflation figures that most investors watch are those from the United States, and that's because the Federal Reserve's monetary policy has a profound impact on all asset markets. As I mentioned in yesterday's weekly newsletter, the crypto market and the stock market both started to crash when Federal Reserve Chairman Jerome Powell testified in front of US politicians last week. I'll be covering what he said during both hearings later this week, so stay tuned for that. Anywho, the figures for the Consumer Price Index, or CPI, which is used to measure inflation in the United States, will be released by the Bureau of Labor Statistics on March the 10th, and it's safe to say that investors are very concerned. This is because the price of energy, namely oil, and the price of food, namely wheat, has gone through the roof over the last 2 weeks. As such, it's almost guaranteed that the CPI for February will be even higher than it was the month before, and this means the Federal Reserve could raise interest rates more aggressively in response. On that note, the Federal Reserve is scheduled to detail a roadmap for how it plans to raise interest rates during its upcoming meetings on March the 15th and 16th. Shortly after the second meeting, it'll be doing a press conference, and what it says could make or break the crypto market. At this point, however, it's worth pointing out that interest rates could be the least of our concerns. High food prices have historically been correlated to large amounts of social unrest, and about a dozen countries around the world are already facing a high percentage of food uncertainty. If food prices continue to rise, we could see more conflicts arise too, and this will only add to the already insane volatility we're seeing in asset markets, society, everywhere. Now, I'm not qualified to give financial advice, but I can tell you to make sure you have enough food, water, and cash on hand just in case, especially if you're in a region where you know you might be at risk. Not trying to raise alarm bells, but as the old adage goes, it's better to be safe than sorry. And I would go one step further by saying it's better to be safe than solvent in extreme circumstances such as these. Turning to the charts, we can see that BTC saw a nice little pump last week before returning to the 38 to 39k range. This is less than ideal, but we seem to be holding strong around that price level and will hopefully see volatility to the upside rather than the downside in the coming week. This week's winners are Waves, Thorchain, Chiliz, Near Protocol and Anchor Protocol. Waves was a weekly winner last week and it's pumping for the same reason. Waves is a Ukrainian crypto project, and with many Ukrainians turning to crypto in this time of crisis, it looks like Waves is getting swept up in that wave of demand. Wave seems to be the only cryptocurrency in the top 100 that's kept most of its weekly pump, but its momentum is running out of steam as people take profits, indicated by the long wicks at the top of the daily candles. Next up is Thorchain, which is pumping in anticipation of its integration with Terra. This will bring UST to Thorchain's cross-chain DEX protocol and could result in lots of demand for Rune. Note that I hold Rune as part of my personal portfolio. Now, as amazing as Rune's pump has been over the last week, it's nowhere close to its recent highs, nor its all-time high, and I'll explain why this might be when I do an update on the project later this week. As for Chiliz, the CHZ token seems to be pumping in anticipation of the Chiliz Chain 2.0, which will be named by the Chiliz community. Like Rune, CHZ is far from its all-time high and has actually been in a downtrend for over a year. There's a slight possibility that this could be a massive descending triangle that breaks to the upside in an epic manner, but I wouldn't bet on it personally. Conversely, Near Protocol's Near coin has been in a consistent uptrend over the last year, and its latest rally is due to the news that a new crypto VC called Move will be investing aggressively in Near Protocol's ecosystem. As I just mentioned, Near's long-term price action looks pretty good, but I'm starting to see the early signs of a gradual decline. And last but not least, we have Anchor Protocol, which was also a weekly winner last week, and that's because its yield reserve treasury was filled with 450 million UST, courtesy of the recently established Lunar Foundation Guard. To my surprise, ANC pumped well past its previous zone of price resistance and entered an unsustainable rally from which it is now cooling down. ANC's price potential in the long term is outside the scope of this video, but I have another one that can fill you in on the details there. That'll be in the description. And that's all for today's Coin Bureau Weekly Crypto Review. If you enjoyed it, you know what to do. Hit that like button, subscribe button, and bell icon too. If you're looking for some hot crypto deals on exchanges, hardware wallets, and trading bots, be sure to check out my deals page using the link in the description. The Coin Bureau podcast is available on all major podcast platforms, and you can also follow me on Twitter, TikTok, and Instagram too. Thank you all so much for watching. Take care out there, and I'll see you all in next week's episode.